Welcome to our deep dive into the Indian financial markets. Today, we're demystifying two fundamental concepts, the primary market and the secondary market. Understanding these is crucial for anyone looking to invest or understand how companies raise capital in India. Let's start with the primary market. This is where companies issue new securities for the first time to raise capital directly from investors. It's essentially the marketplace for new issues. Its main purpose is to facilitate capital formation by allowing companies to fund their expansion, operations, or new projects. In India, the primary market is regulated by SEBI, Securities and Exchange Board of India. Companies typically go through an initial public offering, or IPO, to make their shares available to the public for the very first time. Key participants include companies issuing shares, investment banks underwriting the issues, and of course, investors. The main instruments you'll encounter are IPOs for new listings and FPOs, further public offerings, for existing companies to raise more capital. Now let's shift our focus to the secondary market. If the primary market is where shares are born, the secondary market is where they live and breathe, traded among investors. This market provides a platform for investors to buy and sell existing securities. Its primary purpose is to provide liquidity to investors and facilitate price discovery based on supply and demand. In India, the secondary market is dominated by major stock exchanges like the National Stock Exchange, NSE, and the Bombay Stock Exchange, BSE. This is where most everyday trading activity happens. Participants in the secondary market are primarily investors, individuals, institutions, and traders. The main instruments are the shares and other securities listed and traded on these stock exchanges daily. While both markets are integral to the financial ecosystem, their functions and mechanisms are distinctly different. Let's look at the key distinctions. In the primary market, funds flow directly from investors to the company, aiding in corporate finance. In the secondary market, funds flow between investors themselves. The company doesn't directly receive proceeds from these trades. Price determination in the primary market is often fixed by the issuer or through a book-building process during an IPO. In contrast, secondary market prices are determined by the forces of supply and demand, leading to constant fluctuations. Accessibility differs too. To participate in the primary market, you typically subscribe to an IPO. For the secondary market, you need a trading and demat account with a broker. Both markets play an indispensable role in the growth and stability of the Indian economy. The primary market is crucial for capital formation, enabling businesses to raise essential funds for growth and expansion, thereby creating jobs and driving economic activity. The secondary market ensures liquidity, meaning investors can easily buy or sell their securities. It also facilitates efficient price discovery, reflecting the true value of companies based on market sentiment and information. So there you have it, a clear breakdown of the primary and secondary markets in the Indian context. Remember, the primary market is for new issues and direct funding, while the secondary market is for trading existing securities among investors, providing liquidity and price discovery. Understanding these concepts empowers you as an investor to make informed decisions, whether you're looking to participate in a new IPO or actively trade on the stock exchanges.